Hey, in this lesson, we are going to talk about, there's several things I usually do at this point in the course, although this point in the course is usually earlier in the semester, but whatever. This is about, we're at the point now where we're at financing. So in other words, how do companies raise money? How do they get their hands on their money? So usually for a sole proprietorship, small business, it's usually your money, and maybe you can convince a bank to lend you some. Or if it's a little bit more complicated, it's a partnership, same thing. A bunch of people use their own money, and then it's even a little bit easier to get a bank to lend you some. And then corporations, same thing. They get owners, which are investors, but they do that by issuing shares to raise money. And all of those ways of raising money and a corporation can also borrow money. So essentially, regardless of the legal formation or type, you have two sources of money: equity or investment by owners or others, or two, borrowing. So the rest of the course is about those sections, how money is raised and what it looks like for a partnership. So going back to a sole proprietorship with more than one person, which is a partnership. The only thing actually, you never learned this probably in grade 11, but the only difference between there's legal differences, but in terms of accounting, the only difference between a partnership and a sole proprietorship is the fact that they have more than one capital account and more than one drawings account. That's it. Except at the end of the year, so when either you create the business or you end the business or you break up profit for the year to the different partners. And that's what this topic's about. And later on then in the course, as you can see, we go through we would look at debt, which is largely debt for corporations. So issuing long-term debt yourself called bonds, or other types of long-term debt. We'll probably not get to that. I may skip over debt, but I may talk about the difference between, so corporations have to make a decision. This is finance. Decision between raising their money by issuing debt or raising their money by issuing shares, by equity. And there's pros and cons of each. I will probably mention that in a lesson, but then not really do anything else with debt. But equity is kind of important if you go on and study business or accounting to know how to look at the equity section of a corporation because of all the share accounts. It's different than just that one capital account from grade 11. So that's probably our main topics that are left. A quick dabble in partnerships, a little bit about the pros and cons of debt versus equity for financing to raise money, and then some equity. Look at the equity section. So this one, partnership, really easy. I'm going to go through the lesson up here right where it says partnerships. And then this is video 14. Haven't figured that out yet. You must have clicked randomly. So I'll go through the slideshow and show you just the few slides that you need. We're not going to do much. We're only going to do the key things that really matter that are different. And then the only activity you need to do, you can do these exercises from the textbook, right? This E13-2. You can do them if you want and let me know and I'll show you the solutions. But the only one I want you to really do, because if you can do it, you can do everything that matters, is this self-marking file one. Just do that one. All right, so without further ado, here's what the slideshow looks like. You can skip every slide until slide, this one. There's two ways a new partner comes in. Either you add them or they buy out an existing partner. So if here's my left hand and my right hand comes in to buy out that person who's in a partnership, they make a deal between themselves. This right hand gives that hand money and this hand goes away and that they take that spot. It really doesn't affect the partnership. You have to get a new legal agreement between the partners and stuff, but accounting wise it doesn't really change anything. This person just takes their spot and they do a deal with money between the two of them, right? The way that you need to learn how to manage is if a new partner comes, so in other words there's three partners and a fourth one comes, how do you deal with that? And what usually happens typically is this person brings something. So then, like if you ever watch like law shows on television, right, the part they talk about becoming a partner and they have to contribute money and join and whatever, maybe not. But that's what they do. The new partner needs to bring something besides their underwear. They have to show up with some money or a client list or something, right? And depending on who they are and how badly the firm wants them in, they may be given a bonus or a penalty compared to what they bring in terms of wealth. So that's the first part. So this is a little more detail, but whatever. So this is the one we're talking about. This one where you buy an existing partner, piece of cake. This one requires some accounting dancing. So the way it looks is this. Here's an example. So let's say a business that has, in other words, equity worth $1 million acquires a new partner, and she brings $200,000. I think it's cash. I say it doesn't matter what it is. So $200,000. So now, if you combine all that, the grand total, as it says here, I'll highlight it. The old capital was $1 million. When the $200,000 comes with a new partner, it's $1.2 million, right? So the fair market value of what she brought was $200,000, and they gave her, for whatever reason, maybe she was a high-flying lawyer or something, they gave her a 30% stake. But 30% now of the new total wealth of the business, the partnership now has a $1.2 million equity value, right? So $360,000 is 30%. But she only brought $200,000. So she's getting an extra $160,000. So in other words, existing partners gave her a $160,000 equity, not cash, equity bonus in the business for joining. So she obviously was some talent that they really wanted to get their hands on, or she had a client list that was great, or had whatever. Right? She was bringing Coca-Cola's secret recipe with her, whatever. So the journal entry would be like this. No, you don't actually debit an account called various assets. You will debit the actual assets. But that's, so just to simplify it, income is her $200,000 with a debit, and then you have to debit the existing partners. I made that up. I just split it between two imaginary partners, but it might be split up in other ways. And then you would credit her account with the 360. And that's how you would distribute a penalty through the existing partners and a bonus to the new partner when the new partner only brings 200,000. So that's like one of the two big ideas about partnerships. The second is, what do you do about the profit when it's not split equally, which it almost never is, because not every partner does an equal amount of work in a partnership or the same type of work in a partnership. So these are three typical ways that you break it up, and often businesses do all of them. So here's an example. So if you have $100 of profit or $100 million of profit, whatever, your firm, some partners work there all the time. Some are just investors, they don't work as much, or some have more expertise than others, whatever. So you have this list of things that, and this is why you need a legal agreement, because this would be specified in a legal agreement between the partners. So a fixed ratio for splitting income, you could say there's two partners. This partner gets 60% of all net income. This partner gets 40%. So you do that. Another example, that's a ratio, right? You could also do a second rate. So that's a ratio of profit, but you could also do a ratio of capital. So average capital during the year, or starting capital at the beginning of the year. Or you can even, some give actual interest on capital. So if I, as a partner, have $50,000 of equity in the business and I leave it in the business, then the ratio might actually, the method that you go through to break up profit might actually give me interest on the capital that I keep in there. And it might also pay me a salary. So that's item 3, that maybe I work like 50 hours a week and others only work 10. So I get some money for my labor because I put in more time. In addition, I get interest on the capital I have in, and then I get a certain split of profit. Generally what happens is there's usually a combination. So the next slide is a demo. And let's see if it will actually demo for us. Maybe. So let's say Sarah and Ray are partners, and the partnership agreement says that the net income, so profit, when everything is said and done at the end of the year, is done in the following steps. 1, salaries to partners are given. So it says $8,400 for Sarah and $6,000 for Ray, for whatever reason they came up with that. Next, 2, interest on the beginning capital at the start of the year of 10%. And then whatever's left, you split equally. So you do it in steps. So the beginning capital balances are here too. So Sarah had $28,000, right up here. And Ray had $24,000. And the profit this year was $22,000 to split. So here's how it's done. Sarah and Ray in total. Got it? So the first step said allowances. So Sarah gets $8,400, Ray gets $6,000, which means we've distributed $14,400. That leaves us with $7,600 to distribute. The next step 2 is interest allowance of 10%. So their starting capital balances, right? It says right up here, $20,000 and $24,000. That works out to be then interest given to Sarah on her starting capital of $2,800 and a Ray of $2,400. So total distributed now, total left is $2,400. That's all that's left after you've done the first 2 steps. So the third step is to split whatever's left equally. So that would be $1,200 each. And so when you add all that up, you've distributed the $22,000 by giving $12,400 to Sarah and $9,600 to Ray. So this is not in the accounting journal or anything, right? This is just somewhere you figure this out. And then the way you then distribute it or record it in the journal is done this way. So this happens in the closing entry process. Remember that? You close all your revenue accounts, close all your drawing accounts, you close all your expense accounts into the capital account. But when you have more than one capital account and more than one drawing account, you need an income summary account, which I don't use because you don't need it unless you're a partnership. So if you didn't learn that, watch. It's not that hard. You just plop everything in income summary, and then from income summary, you would split it to the partner. You'll see. So step 1, close all your revenue accounts. So let's say this business had $100,000 of revenue of sales. So we debit that revenue accounts to wipe them out, and we plop all that value, all those credits, into the income summary. Next, you wipe out all the expenses. So reset them for the new year. Take all those debits out by crediting the expense account right here, right? And then you plop those debits into the income summary. Now what's left in income summary at this point should be net income, right? Profit, the difference between the debits and the credits that you plopped in there. So now this is what the previous slide was for. Now you distribute the profit. Okay, so what's left in the income summary account is $22,000 of credits of profit. So you would debit that out and you would credit the appropriate amount to each partner as determined by whatever process you had. And the last step would be if there are drawings accounts, you would then reduce their capital accounts. So after you just increase them by $12,400 and $9,600, you would then decrease those capital accounts by any drawings that they had during the year, right? And I just made this up. So if Sarah had $7,000 of drawings, you'd reduce that from her capital account. And if Ray had $5,000 of drawings, you would wipe out the drawings account, reset it to 0 by crediting the drawings account. And those debits for drawings go into the capital account to reduce the balance that they have in the business. That's it. That's all that matters in this unit. So try that self-marking activity, the one that's on there. And if it's too much, you might want to go back and try the textbook ones. But if you can do that, if you can add a new partner and then do these journal entries and split up profit, you're good. You're golden, right? Let me know if you have any questions.